since the beginning of the year, Treasury yields right now are down 32 basis points, down 32 basis points from the 303 high yield. Does this surprise you in any way, Jim?
People want Treasuries when they want nothing else. I think, Rick, the idea about Treasuries, the central idea concerning the Fed is the Fed insists on saving us from everyday low prices. They call it deflation. I submit that in a world of technological wonder that prices ought to be weakening. It ought to cost less to buy things because it costs less to make them. Now, this benign tendency the Fed resists at every turn. It wants the price level as it defines it to rise by 2% a year, plus or minus. So doing, it creates redundant credit that finds its way into other things. It does mischief, do these excess dollars. And we see this on Wall Street. We call this mischief a bull market, and we're generally all in favor of it.
Now, when it comes to the capital issues that you're describing, where does capital move? Well, to some extent, capital moves predicated on how much capital costs. Has the move down to historic low yields in 2012 for Treasuries in a post-crisis setting, has that misallocated capital? And is that something we're going to have to deal with as the emerging markets kind of rumble a little bit because there's so many liquidity, transmission, and funding issues?
It strikes me, Rick, that the Fed, in substance, if not in name, is engaged in a massive experiment in price control. They don't call it that, but they fix the funds rate. They manipulate the yield curve. They, through this $2 phrase called the portfolio balance channel, talk up the stock market. They have their fingers, their thumbs on the scale of finance. To change the metaphor, we all live to a degree in a kind of a valuation hall of mirrors. Who knows what value is when the Fed fixes the determining interest rate at zero? So I said experiment in price control, but there is no really suspense about how price control turns out. It turns out invariably badly.